Good morning, everyone, and welcome to the JRG webinar for June on employee subsidies, employer reporting, and now what? First of all, I want to go ahead and welcome everyone for participating. Just as a reminder that there will be the recorded copy of the webinar, and the PowerPoint will be sent out to you after the webinar in a couple of days. And any questions that are generated from today's webinar, that they'll be answered, and also a Word document will be sent out to you. Again, another housekeeping, if you have a question, you can go ahead and type the question in, and we'll address it at the end of the webinar. So the next thing we'd like to do is go ahead and thank all of you who are participating from our valued partners, the clients who are members of our partners. Again, we appreciate that participation. So on our agenda, we know the agenda outlines each area in the slide that we're going to be addressing today. And so when I say now what after subsidies and the employer reporting, the now what is that actually the IRS will be now conducting audits of employers. You know, it's another audit webinar basically. They're going to be checking to ensure compliance with the ACA in the area where they will be able to generate sizable revenue. So just a little bit of background, we're going to have some refreshers on the mandates, the reporting, and then we're going to get more into this now what of the IRS audits that will be coming about. So our refresher starts with the mandates and the subsidies. First of all, we know under the individual mandate, every U.S. citizen is required to have what's called minimum essential coverage, or if they don't, that they'll pay a penalty. And in 2016, I believe that penalty is increasing to like $695 or 2.5% of income. The next is the employer mandate that's imposed by the Affordable Care Act. And this is where large employers, those who have 50 or more full-time or full-time equivalent employees in the preceding calendar year, are required to offer what's called minimum essential coverage, MEC, to at least 95% of its full-time employees and dependents, or be penalized at least $2,160 for every full-time employee if at least one full-time employee gets subsidized coverage on the exchange. And the second phase of that employer mandate is that coverage must also be minimum value and affordable. And affordability is always based on the employee-only cost for the lowest cost plan that an employer offers. And for 2016, affordability is based on 9.66% of the employee's income. Now, we know the penalty for that, if the coverage is not affordable or minimum value, is $3,240. And that penalty is only assessed against each full-time employee who gets subsidized coverage. And then finally, we're going to talk about, this subsidized coverage. Really, how can an individual get that, and what is it? It is available on the exchange, and it's only available to certain individuals whose total household income is less than 400% of the federal poverty level. And the cost that they would be able to receive this subsidized coverage at would be between 2% and 9.66% of that total household income. So we know that besides the employer mandate, that the Affordable Care Act also imposed a reporting requirement on large employers. And that reporting requirement, again, just a little bit of refresher, it required that a large employer had to provide a statement, also known as a Form 1095-C, to all full-time employees who were full-time for at least 1 month in the year. And then finally, after all the 1095-Cs were done, they had to be transmitted to the IRS using a Form 1094-C. So just want to go ahead and, again, remind you what kind of basic information had to be included on those reports. We're looking at general employer information, name, address, EIN, but also a contact name and contact information. Also, so we look at name and telephone number. And then also you included a certification by checking a box on the 1094-C, whether you offered the coverage to full-time employees. On the next slide, continuing just again with the refresher, on the 1095-C, a lot of information in a very short form, to me, had to be completed. So there was a use of a lot of indicator codes, and there were at least 16 indicator codes that could be used. And some of the information that these codes shared is whether you offered coverage to spouses and dependents besides the employee, whether that coverage was minimum value, whether it was affordable, or basically whether you didn't offer them coverage. And also whether maybe this employee wasn't offered coverage during a certain time period because they were in a waiting period. They had to wait before they became eligible. Also, we had to put in there effective date of coverage, whether it was affected again by the waiting period. And each of these indicator codes had to be done on a month-by-month basis, generally. So that's the type of information that we did reporting on our 1095Cs and 1094C. Briefly, just a reminder that, well, the deadlines are almost all passed now, and even though they were extended. But we had to give the 1095Cs to our full-time employees by no later than March 31st of this year. And then we had to report to the IRS the transmittal form either no later than May 31st if we were filing paper forms, or by June 30th if we're filing for 250 or more forms, or if it's being done electronically. So the key thing that I want to note on this slide, though, is, again, those dates were all extended for 2016, which was your 2015 reporting requirement. For the 2016 reporting requirements, so far there have not been any inkling that there are going to be extensions. So we're almost already in the middle of the year, and if you haven't started tracking your information and how you're going to file your reports, you really need to start looking at that now, because 6 months will really go by quickly. So after all of the, reporting of the information, we want to go ahead and talk about the penalties. So in August of last year, it was provided that the penalties for failure to comply with the reporting requirements were more than doubled. Previously, for failure to file a return or a report, it was $100 per form. Again, that was increased to $250 per form. And that's either for failure to file completely or to file timely a report. Now, since these reports are provided to the individual or an employee and to the IRS, that penalty is basically doubled. So it's $500 per failure per form. And we have about a maximum of penalty of $3 million. On the one hand, there's every reason to believe the IRS will be merciful in its enforcement. After all, they've been advising us for months and months that if good faith effort is made, that there would be some type of penalty relief. Now, on the other hand, with the implementation of the ACA being delayed for a year, it's considered that employers had plenty of time to figure out the compliance based on the regulations and guidance provided. So even though there may be some relief may be available based on good faith and reasonable cause, it's not going to be unlimited, and it definitely will not go on forever. On the next slide, I'm going to go ahead and just talk about this good faith compliance standard for just a minute or so. Some relief to employers when the IRS, it was relief to the employers when the IRS announced that, some penalties would not be enforced, or they may be limited if the employer met a good faith compliance standard. Now, the IRS just about a month ago actually put out a video, and they talked about really what is this good faith compliance standard. And really they had stated that the expectation was that employers would do their best to go ahead and meet this obligation. And in this video, it also stated that just providing names and addresses does not meet the good faith relief. And it would be also it would not be available for failure to file accurate and complete returns if that good faith effort isn't demonstrated. So what's also key is that the IRS has said that in order to show this good faith effort, if you made any mistakes, you have to correct them. And that if you don't correct them, you also have not demonstrated good faith. So here comes the full punch of the penalty again. So kind of like, really giving us this relief, but putting so many conditions on it. So again, once you become aware of errors, they have to be corrected as soon as possible. How can you become aware of an error? Well, maybe you might be reviewing your forms and you say, oh my gosh, I put the wrong employee name down, or I know I put the wrong Social Security number down, and you have to correct that. Also, an employee could make you aware of incorrect information on the form, and then finally, the IRS could also advise you. So when we're doing these corrected forms, we're also reminded that not only does the corrected form have to go to the IRS, but it also must go to the employee. We know that in making corrections, we can correct the 1095B, the 1094C, and 1095C. Basically, the 1094B cannot be corrected. So some of the errors that they are talking about that you might get either a notice saying it has to be fixed, mismatches between names and Social Security numbers, incorrect use of safe harbor or relief codes, premium amounts may be incorrect. So again, those are things that you might be looking at. The employer also, you will need to file a correction along with the original information. So you just don't file the corrected. You have to also refile the original information. And basically, the corrected form will take the place of the previously filed form, though. So as to correcting, that's about what we have on that. We want to talk just a second about incorrect Social Security numbers. The IRS was really making a big issue about this. And this is generally more for self-insured employers who have to report minimum essential coverage. The requirement was that they had to have the Social Security numbers of any individuals who were covered. And some employers said, you know, geez, we don't have that. It's going to be hard to get it. What the IRS told us is that in order to show good faith effort to have a Social Security number, that you had to make 3 solicitations to get that number. And in September of last year, the IRS gave us additional guidance, and they said, how do we meet this 3 solicitation requirement? The first solicitation is when an employee goes through open enrollment. We should be asking them for Social Security numbers, not only for the employee, but for any dependents that may be covered. The second solicitation, and I don't think they could be more vague on this, said a reasonable time after the first. And then finally, the third solicitation has to be made by December 31st of the year following the initial solicitation. So let's back into this for a minute. So if our initial solicitation was, let's say, during our open enrollment of September of 2015, we had to make our third solicitation by December 31st of 2016, that means that basically within that 15-month period, we had to also make a second solicitation. I think the key thing that we have on this slide is do not ignore any error notices. So if you get something back either electronically, if you file electronic, or if you get a paper notice that there's been an error, you know, don't just say, oh, well, you know, better luck next time and throw it away. Make sure that you address it as soon as possible. In talking about, I'm going to digress back to the Social Security numbers for a second. We also want to make sure when we have the solicitation requirement, if we do make 3 solicitations of a Social Security number and an individual still does not give it to us, then we can go ahead and use a birth date. Now, what the IRS has said, in correcting these forms, we cannot default to the birth date. You must have correct Social Security numbers. And the birth date is only applicable to a spouse or a dependent. So as an employer, you're required to have that correct SSN. And if it isn't correct, let's just think about some areas where we might want to go besides just the ACA reporting. We have an incorrect Social Security number. Was the W-2 correct that we gave out? Maybe it was also incorrect there. What about our I-9 form? Try and say that real fast. I-9 form. We also may have improper or incorrect information on that form that may need to be researched to make sure that it is accurate. So on slide 10, just wanted to go ahead and really show you that the process that's starting from verification of the employer's reporting information, the 1095Cs, the 1094, any confirmation of subsidies, that the IRS is not working in a silo. Basically, these are all the federal governmental agencies that will be working with the IRS to do their cross-checking, to see what was given to who, when, did they have a right to receive it, how did they receive it. So as you can see, there is a lot of interaction here. And not only between the governmental agencies, but also between the private sector. So again, it's going to be bringing in insurers, employers, and also individuals. So what happens after the filing? So although this is not a strict timeline, because it hasn't been provided by the IRS, this is generally how we think the IRS auditing or reviewing an enforcement schedule is going to look like. So definitely by June 30th, all 1094Cs and 1095Cs must be remitted to the IRS. That was the final deadline, and there's no extension. So probably starting in July, the IRS will start doing its cross-referencing and checking and seeing, who's received a subsidy, what employer did they work for, did the employer offer affordable coverage, was it minimum value? And then sometime either in August or maybe a little bit later, maybe in September, the IRS will begin citing employers regarding any type of reporting deficiencies or discrepancies, possibly assessing penalties at that point, and asking for corrected forms. Starting in November, the auditing will continue. They'll probably start phase 1 again, and then December, and then continuing into next year, they will go ahead and still, again, be citing employers, looking for corrections and looking for payments. So, and while the IRS, we're not told they will target certain industries as they start this auditing process or verification process. We don't know if it's going to be, geez, we're going to look at companies as they replied, as they sent in their information, or, are they going to look at low-hanging fruit? And in this instance, low-hanging fruit are really going to be companies that, or industries that had a lot of fluctuating hours, that, there may have been a lot of turnover. So that can be an assumption where the IRS will start looking because, again, it will be easy pickings to possibly get penalties assessed. So those types of industries might be restaurants, staffing firms, hospitality services, and industries like home health care. So again, after this filing, what's happening? We're going to be going through a certification process as to employers. So if an employer is found to owe an assessment of the employer mandate, it's known that the first step is that the IRS will send a certification to the employer or proof that an employee has received a subsidy. And then the IRS will probably contact the employer again after that letter is received, but at that point the employer will go ahead and have the opportunity to appeal or challenge that information to say that, geez, I offered affordable coverage, I offered minimum value, that this employee shouldn't have received that. After that appeal or conversation with the IRS, if it's still found that there is a penalty that will be owed, then you will receive a letter a demand letter and a payment letter. The key thing is to know that if you are assessed a penalty, that you won't be filing it on any of your reports. Like you won't be filing it on your 940 or your 941 or a 720, which is an excise tax form. You'll actually be doing it now in the same manner if you would be penalized by the IRS for any other reason. And that is basically you will send the payment. There won't be a form that will be required. The key thing we want to recognize on this slide, these are assessments and technically not penalties. They are non-deductible excise taxes. So if you are penalized, you have to pay this amount of money, you cannot take this as a business expense. You can't deduct it. And again, we talk about that you have the right to appeal. You may want to challenge it. At all times, you as the taxpayer, you bear the burden of disproving an assessment. So in a couple of slides, we're going to be talking about how will you show that? What kind of documentation do you need? And actually, we're going to start talking about it right now. So when we file our personal income taxes, I know something in the back of my mind, at least, I'm always saying, oh my gosh, if I get audited, do I have all, do I have support of all the information that I put on that tax form? Did I move it around? Did I keep everything when I did my filing? Where is it? Because again, we're always afraid of being audited. As an employer, it's probably the same question that should be going through your mind or that should be considered. So if I would get audited based on any of my filings, do I have the documentation? Do I have the support to show that everything I put on there is correct? And again, we had a lot of information that was supplied to the IRS. They now know whether we're under a common control group, whether we're just a single employer, how many employees we have, when our coverage starts, what our waiting periods are. Again, we're pretty much an open book now as to offering health care coverage. And when we talk about maintaining documentation, I think one of the first things that you really want to ensure that you have, and that's the documentation about whether you are or are not part of an aggregated ALE group. Now, just as a reminder, why it's important is because if you are part of an ALE aggregated group, which is also referred to as either a common control or a controlled group, then you are looked at in the aggregate to see how many employees you have. Every company that's in the control group is totaled together to say, if together you're over 50, then you're subject to the employer mandate and the reporting requirement. And as another reminder, however, when it comes to assessing penalties, each employer member in the aggregate group or control group is looked at separately. So what kind of documentation should you have? Definitely any kind of legal determinations. If you filed something with the state as to being incorporated, if you had to go ahead and provide ownership or whatever, that would be great documentation. I'm trying to think, again, probably basically any type of filings to show what kind of legal entity you are. We've already talked about doing the math. We want to see, are you part of a bigger group or are you just really only a single employer? And what's key is because on that 1094C that you had to file, you have to go ahead and state whether you're part of an ALE, if you're an ALE member. And if you are, you had to provide information, basically the EIN, for any other members who are in that control group. So why this is key to know is the last thing you would want to be is sitting in your office and you find out that you're actually a part of an ALE group because another member reported you as being a member and you haven't done any type of filing. You never want to be in that situation. So some other things that we want to maintain as to our documentation in case of an audit are classification of employees. Have we properly classified? Have we designated our employees? Have we given them designation letters saying, you are a full-time employee, you're expected to work on average 30 hours a week, or you're going to be part-time, or you're going to be variable hour. We really don't know when we hired you how many hours we expected you to work. Again, full-time on average works 30 hours a week or 130 hours a month. In that variable hour, we're not sure how many hours they're going to work. So some other documentation the IRS may be asking you for. How did you determine if someone is a full-time employee? Did you use a monthly measurement period? Did you use a look-back measurement period? How did you set that up? When did you set it up? How did you administer that? When were your initial measurement periods? What about your ongoing employees? How did you designate that? Something else that they're looking at is, because you have to report it on the 1094C, you have to report your total number of full-time employees and then your total number of all employees. So they're going to ask, When did you make the determination? Where was your count based on? They tell us there's basically 4 ways that we can make that count. We can look at either the first day of the month, the last day of the month, the 12th day of the month, or the first or last day of the payroll that starts each month. You need to have that documentation, and you need to also show that you didn't do any mix or matching. If for January you chose the first day of the month to determine what your full-time employee count was, you had to use the first day for the entire year. I think something that's key to remember, we're talking about, the measurement periods and stability periods. If you do not formalize your process by writing it down and, maybe communicating it to your employees, that process is basically now in place by default. Because when you filed your 1095-Cs and your 1094-C, you basically said, this is how I treated my employees and how I came to the conclusion whether they were full-time and offered coverage. So even if you didn't formalize it, you documented it by doing the reporting that you did. On the next slide, we're still talking about maintaining documentation. We want to go ahead and have a documentation of our business decisions. What about eligibility for our employees for the health care coverage? We have a waiting period. Does our waiting period comply with the, cannot have a waiting period that's more than 90 days? Is it consistently applied? For our managers, do we have no waiting period? And maybe our staff, we have a 30 or 60-day waiting period? Also for business decisions, how did you demonstrate any transition relief that was asserted? Now we know as to the employer mandate, if you were what's considered a mid-size employer, between 50 and 99 employees, that you didn't have to offer coverage, but you still had the reporting side of it that had to be done. And in order to get away from that offer of coverage, you had to make a certification. In that certification, you had to say, we didn't drop our employee count to go below just to get around not having to offer coverage. We didn't change our offer coverage. We didn't change any of our contribution requirements for the coverage. And when you did your 1094-C, that is the certification you made. What about documentation for your plan year? Do you have it established in your plan or SPD? Or are you relying on some other material? We've kind of talked about good faith efforts already and making sure that the collection of Social Security numbers that you followed that 3 request requirement. Other things that I don't have outlined on the slide, but that you would have to demonstrate, how did you determine affordability? Did you use W-2? Did you use rate of pay? Where are your calculations to show that the coverage was affordable? What about your premium cost? Where do you have that maintained and documented? Can you demonstrate that you offered coverage to all your full-time employees? What if somebody waived? Did you get a waiver form from them? Does your waiver form say that the employee had the opportunity to either elect or decline coverage? Also, we're going to look at the last bullet for a second. We always talk about compliance. We're always talking about our plan documents and our summary plan descriptions. But we know as employers, you give out a lot of other documents that record benefits that are available to employees, what kind of classification the employee is. And so it's key that everything that you are communicating to the employee is consistent. So you need to make sure that your job description, your employee handbooks, again, your risk plan documents, everything is consistent. So when we're determining who is a full-time employee, the Affordable Care Act says that we look at hours of service. And the Affordable Care Act also says that you include non-paid family medical leave, USERA, and jury duty when you're determining those hours of service. Is that what we put in our employee handbook, or does that say something different? Are we creating conflicting information such that if the employee would make a challenge, that the ambiguity created, it would have to be ruled in favor of the employee? What about rehire provisions? You know, in working on plan documents and SPD for employers, I see a lot of, oh, if they're rehired, they have to wait, 60 days or 90 days. If you're subject to the Affordable Care Act because you're a large employer, remember that rehire provision says that if someone comes back and they're gone for less than 13 weeks, they come back as what's called a continuing employee. A new waiting period can't be imposed. If they were receiving coverage before, they get to receive it again. We need to know about the available benefits. Again, we're not creating either conflicting information or discrepancies between these documents. Did we communicate our measurement and stability periods as a term of eligibility? In talking with employers, as I've been out doing a lot of compliance reviews for our clients, the question that I probably get asked the most is, when we have to do all of this reporting and this recording and documentation, is there any assistance out there for us? And so they're really mean, is there technology? Because nobody wants to be doing all of this by hand. It does require a lot of gathering information, maintaining it, keeping it updated. So we do know that there are companies out there who provide these types of services, and that there's also software packages that you can purchase that will do some of this. But I just wanted to go ahead and add this slide because if you're considering either purchasing some kind of technology or going into a contract with a vendor, some of the things that you want to make sure that the service is going to provide to you are flags. And the information that you're tracking will note rate of pay changes, hours creep alerts. So if you're watching to make sure someone doesn't work over 30 hours, do you get any kind of reports or notices on these individuals? The hours calculation saying, yep, somebody is working 30 hours a week and it's been consistent. What about leave of absence administration? Paid versus unpaid family medical leave, but if someone goes out on a sabbatical, if someone's out on disability due to workers' compensation or due to some other type of injury that isn't work-related, can the system track that? Breaks in service. Does it follow the 13-week break in service rule versus the parity rule? Something that you would want to know. Changes of employees from full-time to variable or variable to full-time. Again, do you receive some kind of flag to say, hey, you may have to offer this employee coverage? So again, we just kind of want to put that in as a tip. And then finally, we're going to be talking again today about something that we talked about, I believe it was either last month or 2 months ago. And this is what's called the Employer Notice Program. Now, there's an assumption that if an employee receives subsidized coverage on the exchange, the employer would want to know about it. And that the ACA requires the implementation of this Exchange Notice Program. And the purpose is to notify employers of employees who are receiving subsidies. So that's the what of the program. So let's talk about the when. This program is starting in 2016. Some states actually started giving state notifications from state exchanges last year. But generally the federal exchange is starting this year. And some employers, not all employers, will be receiving notices. And that's again because the program still is not in full force. They're trying to make it a baby step process. So every employer who has an employee who has received a subsidy may not receive one of these notices. And again, who's going to be receiving them? Again, maybe not all of you, but it's employers whose employees did receive a subsidy. And the key is that employee provided the employer's address as part of their process in receiving coverage on the exchange. And the why, it's really a part of the enforcement of the employer mandate. And again, although no liability is assessed by the IRS when these notices are sent out, there could be an assessment of the penalty later on by the IRS. And continuing with this notice program, how? The key thing is you would be receiving a notice, and it probably is going to have a sticker on it that says very important information. Once you do receive that, you have time to review it, and then you have 90 days to make an appeal or to challenge it. As to making the appeal, it can be done verbally, it can be done on the phone, it can be done email, or other types of writing. Once that appeal is made, and what you would be making an appeal to is you would say, hey, wait, why is this individual getting subsidized coverage? I offered coverage that was minimum essential, it was minimum value, and it was even affordable for that employee. So I'm not sure why they're getting that subsidy. Once you make that appeal, the marketplace will review it, make a determination. Once the determination is made, they let the employer know, and they also let the employee know. So how can you prepare for these exchange notices? Now, we've already noted that employers are not exposed to any penalties through this notice program. However, it could assist employers because if they are a large employer, knowing employees are getting a subsidy, an employer may want to step back and say, well, geez, if they're getting a subsidy, why? Isn't my coverage affordable? Is it minimum value? And an employer can take the time to assess their benefit program and maybe make the change, and thus possibly mitigate any kind of IRS assessments that can be opposed against them. Also, it can also assist employees. What we all need to be aware of is that if an employee receives a subsidy and they weren't eligible for it, they're going to have to pay that back. I read a report several months ago where they said the average repayment of subsidies that were received that shouldn't have been received was around $4,000. That's a pretty hefty amount for the IRS to go to the employee and say, hey, guess what? You received $4,000 you shouldn't have. You need it back now. So it won't only help you as the employer with your basically mitigation of any type of penalties, it could also assist the employee. Then we want to do a risk analysis to these notices. Should we respond or not? Now, this gets to be a really murky area because we're asking, can knowledge of the subsidy receipt be construed to impact any adverse employment decisions? So let's say that, you get a notice and you know that an employee is receiving a subsidy, and the next thing, this employee maybe happens to be one of your, non-performing employees. Then you have to terminate this person. And this employee then comes back and says, this was a wrongful termination. It was a wrongful discharge. And it seems funny that nothing was ever said to me about my performance, but all of a sudden, when you know that I'm receiving a subsidy, you terminate me. So, again, what's being recommended out there? That you may either want to have counsel review any of your notices that you get, not even opening them up, just automatically passing them down, or maybe some other type of third party. This kind of will put up a buffer or some kind of shield to you because you can basically say, yeah, I made an adverse employment decision, but I didn't know if that employee received a subsidy or not. The attorney handled that, or the other third party handled all of that. I didn't have any knowledge of whether a subsidy was received or not. So again, that's something that you need to think about or consider. So your process, anyone who handles the mail should know what an exchange notice looks like, so it's actually not, accidentally discarded, and to ensure that it is sent to the right person who would respond would get it. So you should know who is going to respond and what's your process for responding. Your documentation to any type of defense. Yep, our coverage was affordable. We looked at every employee, looked at their wages, looked at the premiums, and here's all of our calculations. And then be consistent in any type of reporting. So in the next two slides, we're going to talk about some takeaways that you should have for today's presentation. Again, as a reminder, in 2016, all ALEs have to comply with the employer mandate. There's no type of transition relief. So that means if you had 50 or more full-time or full-time equivalent employees in 2015, that as a large employer, you have to offer coverage to your full-time employees and their dependents. It has to be minimum value. It has to be minimum essential coverage and also affordable. The employer mandate penalties increased for 2016. They're up to $2,160 for not offering MEC, $3,240 when the coverage is either not affordable or it's not minimum value. Also, affordability increased. It's now up to 9.66% when you determine the cost of coverage for an employee. So something else in 2016, be prepared to respond to these employer exchange notices. We just mentioned that, are you going to look at them? Are you going to have a third party answer them or respond or challenge them? Be prepared for any type of ACA audit based on your information reporting. Know your control group determination. How did you determine full-time employee status, whether they're part-time, full-time, or variable hours? The total employee cost and your count. Did you use the first day of the month, the last day of the month? Did you document your offer of coverage? If someone you offered coverage to waive, did you get that waiver form? We mentioned affordability. Have consistent communications, again, with your job descriptions, with your employee handbooks, plan documents, any memos that you're handing out. Make sure that they're all consistent. And finally, the last slide, watch for IRS communication regarding changes to forms. We know that the 1095-C and probably the 1094-C will be changing for the 2016 reporting. We know this because the IRS has already told us that they're going to be including more indicator codes. So again, as they put out more information, they're going to have to change the forms. And if the government does arrive at your organization, there's going to be a good chance they're probably going to be asking for more information than just reporting. They're going to be looking at probably your benefit plan documentation. If you have a wellness program, compliance in that area. HIPAA privacy, if you have any type of self-insured plan, such as an HRA or a health flexible spending account, or just a major medical self-insured program. Several topics ago, we talked about these memorandums of understanding. We know that federal agencies such as the IRS and Department of Labor, they've got these agreements saying, well, if we're in auditing an employer and we see something wrong that you need to be taken care of, we'll go ahead and we'll notify you so you can come in and look at them also. We know these memorandums of understanding also go to state agencies. And then finally, understand and know your employee benefit eligibility rules, how they work, how you apply them. So the ACA requirements and your plan document align. If we looked at, the ACA says they have to work 30 hours, but if we looked at your eligibility, does your eligibility for your plan say they have to work 40 hours? Watch for those types of inconsistencies. Again, rehires and breaks in service. And what about when is COBRA offered? Have you amended your plan to go ahead and comply with the ACA, or are you still managing it in a different manner? So with that being said, we've come to the end of the presentation for today, and we'll go ahead and see if there are any questions that you may have. And currently we don't have any questions. So while I give you a few minutes to see if some questions are going to come in, go ahead and want to remind you that our next webinar is going to be on July 14th at 10 o'clock in the morning. And I believe the topic on that is going to be employee benefit alphabet soup. Good. Also would like to take this opportunity, first of all, I can't tell you how much we appreciate you participating in these webinars monthly. We do know that there are several of you out there who come on every month and listen to the program. So we appreciate that loyalty that you have to us. And at the same time, if you have a topic or issue that you say, well, I really would need some clarification or just a refresher on that, please feel free to email me, and we would be glad to put that topic on our webinar schedule. So at this point, we don't have any questions, so I'm going to go ahead and end the webinar. Again, thank you very much for participating, and hope you have a good day today.